In this video, I'll explain what market capitalization is, how it can help you make investment decisions, and I'll walk through an example of how to calculate it. Market capitalization is one of the most common stats an investor will look at on a company. If you spend any time on exchanges or stock research websites, you probably see market cap everywhere, even if you don't realize it. Market capitalization or market cap is how much a company is worth as determined by the stock market. You can calculate a company's market cap by multiplying the number of outstanding shares by the current market value of one share. Market cap can give you information about the relative size of one company versus another. This is why stocks are often split into categories based on their market cap, usually large cap, mid cap, and small cap, but you can also include mega cap and micro cap in there. Large cap stocks have market caps of more than 10 billion. Most of the best known companies in the world are large or mega caps, and these are typically the companies that have established themselves as the leaders in their industries. While many deal with the ups and downs of their industry cycles, these are often the strongest companies and have proven capable of holding off competitive threats. Large caps are often where you'll find the best dividend stocks. These large companies often generate more cash than they need for the business and return that extra capital to investors in dividend payments. Mid-cap stocks have a market cap between 2 and 10 billion, occupying the middle ground between large and small cap companies. Mid-cap companies often have made considerable progress in building up successful business models, and that gives their investors some stability and protection against the future challenges smaller companies may face. Yet even with some track record, mid-caps often may face the task of beating out or even disrupting bigger and better funded large cap competitors to realize their own financial promise. Not all mid-caps are growth stocks. They may be companies that operate in a smaller niche without big growth prospects, or they may be former large caps that have declined due to changes in competitive landscape, or, like a lot of brick and mortar retailers, some industry disruption. Small cap stocks are generally defined as having caps between 300 million and 2 billion. Sometimes companies with market caps below 300 million are in this group, although most categorize those as micro cap stocks. They are generally growth stocks or upstarts just getting their feet under them and looking to do something big. While small cap stocks have historically delivered above average returns as a group, many fail to live up to expectations. Small cap stocks are more volatile than larger caps, meaning there is more risk of losses in the short term. These stocks are generally best owned as a diversified group and for many years in order to reduce those risks. Market capitalization is commonly used to help inform decisions about which stocks to invest in because it gives investors information about the relative size of one company versus another. This is why investors tend to split stocks into categories based on their market capitalization, again usually large cap, mid cap, and small cap. Market capitalization is a simple and relatively effective way to assess risk. Investing in large cap companies is thought to provide long-term rewards and less risk, as the companies are well established and stable. Mid-cap companies have great growth potential but tend to be riskier than large cap stocks, although not as risky as small cap stocks. Small cap companies are often considered a higher risk investment choice due to the factors like their limited financial resources. Although there can be a variety of benefits of using market capitalization to identify which stocks to invest in, there's also certain limitations to this method. For example, a business's worth, its enterprise value, is not accurately reflected in the market cap. It only reflects equity value. Share prices may be over or undervalued because they only reflect how much the market is willing to spend. Some traders and investors, mostly new traders, can mistake a stock's price to be an accurate representation of that company's worth, health, and/or stability. They may perceive a higher stock price as a measure of a company's stability or a lower price as an investment available at a bargain. Stock price alone does not represent a company's actual worth. Market capitalization is the correct measure to look at as it represents the true value as perceived by all the overall market. For example, Apple at the stock price of $175 per share had a market cap of about 2.85 trillion, while Adobe with the highest stock price of $455 had a lower market cap of about 215 billion. Comparing the two companies by solely looking at their stock prices would not give a true representation of their actual relative values, even though they're both huge. With billions of dollars worth of valuation, a large cap company may have more room to invest a few hundred million in a new stream of business and may not take a big hit when those ventures fail. But a mid cap or micro cap company making a similar value investment may be susceptible to big blows if their venture fails, as they don't have a bigger cushion to absorb the failure. If the venture succeeds for large cap companies, it may appear small in their profit numbers. But if the company scales up with its success, it can lead to profits of larger magnitudes. On the other hand, the success of similar ventures for a mid cap company can bolster its valuation to significant heights. Valuations of mid cap or small cap companies often take a hit when there's a report of a large cap company encroaching into their space of product or service. For example, the entry of Amazon into cloud hosting services under the Amazon Web Service (AWS) umbrella has been posing a threat to smaller companies operating in that niche space. Generally, investments in the mega cap or large cap stocks are considered more conservative with less volatility than investments in small cap stocks. Though mid and small cap stocks offer high return potential to risk taking investors, the relatively limited resources at the disposal of such companies make their stocks more susceptible to competition, uncertainties, and business or economic downturn. Market cap values also form the basis to launch a variety of market indexes. For example, the benchmark equity index, the S&P 500, includes the top 500 US companies, which are weighted based on their market cap value, while the ASX 200 index includes the top 200 companies listed on the Australian Stock Exchange with the highest market capitalization. These indexes not only represent the overall market development and sentiments, but are also used as benchmarks to track the performance of various funds, portfolios, and individual investments. All right, let's look at an example. You'll essentially never have to work this figure out yourself because it'll be high on the page of any stock's key information on any market website. But let's look at an example anyway. Using an online market cap calculator, remember this is how the calculator will find the figure. Price of share multiplied by the number of outstanding shares. So let's say a company with 20 million shares is selling for $200 each. This company would have a market cap of $4 billion. The investment community uses this figure to determine the company's size as opposed to sales or total asset figures. In an acquisition, the market cap is used to determine whether a takeover candidate represents a good value or not to the acquirer. So to finish up, as we've established, market capitalization has its limitations, but it can be a very useful tool for investors. And it also gives business owners and board members an insight into how their company will be perceived by investors. Investors use market cap not just to gauge the business's size. They'll also keep an eye on issues that might affect market cap, such as falling share prices or an increase in exercising of warrants that would make more shares available and potentially drive share prices down. Having said that, a business's worth is often not accurately reflected in the market cap. It only shows equity value. Share prices may be over or undervalued because they only reflect how much the market is willing to spend. This is why, although there are benefits of using market cap to identify which stock to invest in, there's also many limitations to this method because it's just the tip of the iceberg.